Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Welcome back to the Investing Podcast. I'm with Matt Krebsbach today. My name is Ben Nye. We're talking a little bit about IBM. They reported earnings last night, gave their conference call. Actually took questions this time. CEO Ginny Rometty was not on the conference call, but that's kind of par for the course for that company. Kind of quickly get into the headlines. Revenue missed again estimates. Revenue came in at $18.2 billion. Estimate was $18.4 billion.
20th quarter in a row, correct?
20th quarter in a row. 5 years in a row where they missed estimates every single quarter on revenue. But they beat EPS. Adjusted EPS was $2.38. Estimate was $2.35. Gross margin, 44.5%. Estimate was 46.9%. So they really underperformed on revenue, really underperformed on gross margin. Did decently well in cutting their SG&A, and then they also had a very low tax rate. Effective tax rate, even on the non-GAAP, was 15%. Although if you do look at the income statement, you see like a negative 80% tax rate. So it's just a accounting mess, their financials. Yeah. But it's been that way for a long time. And I know there are a lot of short sellers who say IBM's accounting is awful. IBM's accounting is awful. You got to short the stock. But I mean, they've been saying that for a long time, and it seems like that news is out there. So for the bears, what do they have to look forward to in the accounting that they haven't been pointing to before?
Well, I guess what they haven't pointed to before, your biggest issue with IBM has been their adjusted numbers that they keep pulling out. Yeah. And those adjusted numbers have so much to do with the acquisition expense that they put in there, which they've been doing for years, just like trying to bolt on to supplant that revenue growth, or I guess try and stop the bleeding in terms of revenue decline, I guess is a better way to put it. So they've been doing that for years, just keep bolting on. So that's not, to me, it's not truly adjusted. That's more like accurate, like EPS.
And then going forward, I guess the question becomes, how do we look at IBM? Do we look at it as a company that is going to be a serial acquirer? And if that's the case, do we need to factor in the cost of acquisitions, the intangible asset amortization, because this is happening again and again and again? This is not a one-time issue for IBM.
Right.
It is essentially a roll-up entity. But I actually did an analysis.
I'll touch on, I think you kind of have to do it that way.
Yeah.
But then, I mean, they're saying the second half of the year is going to be great or better than the first half. So they're basically throwing the towel in the first half, saying this is, adjusting, and then they're going to roll over on those acquisitions so that'll start, blossoming in the second half.
Exactly.
So, I mean, if you take the word for it, I don't know if they deserve that credit. I don't know.
Right, and the second half is something I want to hit on a little later. I also wanted to kind of bring to the attention a metric that I kind of look at for IBM, because there are so many accounting shenanigans going on. It's like, how do you distill that? So I just constantly gravitate to, well, what's the balance sheet doing on a year-over-year basis? Is the book value improving? And then you add in the dividends on top of that, because dividends obviously coming out of the stock. So I like to look at the dividends plus the year-over-year change in book value, and you are seeing an improvement in that metric on a year-over-year basis. You're not talking about the $13 or so that they like to say is what they're earning, but it's still $10, and at 16 times a more fairer earnings number, I think that's reasonably fair for a company like IBM. I mean, you look at something like Microsoft, which is perhaps more expensive, but I think a mid-teens multiple, if you're truly looking at what value are they actually adding, I think that's something that's kind of respectable. But you touched on their expectation for a strong second half of the year. Do you buy into that, and kind of what's their rationale behind it, and are you buying it?
I don't think so. I feel like it's the type of company where they've dropped the ball so many times repeatedly in the past that I mean, I personally am really skeptical of it. I think it was like, 2 years ago they said, oh yeah, we're going to get $20 in EPS this year.
Right.
And then like a few months later, like, yeah, we're not going to do that.
Yeah.
So, and there's a lot of companies that are like that, and I think this is one of them where you have to be really skeptical on what they say. Right. I think you probably feel the same way.
I do.
Correct me if I'm wrong.
No, I do, and that's kind of been my base case for a long time on IBM. I have to say I'm a little more encouraged. I think the accounting adjustments have declined a little bit. I'm not going to say it's all great now on the accounting side, but I think they've improved a little bit. Kind of getting to what you were saying earlier, it seems like the intangible asset amortization is a little more fair now. It's not so much on the restructuring side, which I think it was in the past, where you could just lump expenses into call it restructuring and then adjust it out, which I think is a game that not just IBM plays, but a lot of companies play.
Let's assume that IBM like turns the corner where their strategic initiatives are growing faster than the legacy business are declining. At that inflection point, kind of like an Oracle. Like Oracle is kind of at that same point, a different company, but same idea. Right. When it gets to that point, do you think anything will change, like valuation-wise, on IBM?
Well, you saw it change a bit with Microsoft.
I'm assuming it will happen at some point. Let's just assume it happens at some point. Are you expecting a paradigm shift there?
I think just the nature of a faster grown business. I mean, if you put that into a DCF model and you have a higher growth rate, you're going to have a higher value. That said, what the big X factor is, what is the base? Because if the base is like, I mean, they did $18 billion this quarter, so let's say the base is $12 billion, or is the base $15 billion? And I don't know where that ends up shaking out. So that's a big question mark, I think, for IBM. One of the other positives that I was kind of pulling from this is that, revenue declined on a year-over-year basis, and it declined more on a year-over-year basis than it did in the December quarter. But it was a bit of an easier comp, and I think that the story they told this quarter about having a better second half, it actually has a little more to it than what they've had in the past. I feel like in the past they were totally out on a limb when they were just so focused on EPS, and I think this time they do understand a little bit more about what the street is concerned about. They know they had a big miss on gross margin, and they came out and explained. They said they're launching new systems and they're digesting those acquisitions, and that should have an improvement on gross margin. Obviously, it's still a very macro play, but I think there is a little more cause for optimism than the street's given them today. The stock's down 5%.
The street's been like bearish on them for a long time too.
Right.
Like I was looking before, their average price target on IBM was I think 168, which I mean for the street average analyst estimates, that's really low.
For a blue chip company like IBM,
usually they're at least like 20% higher than current market price. But.
Yeah. Do you think that 5% decline is justified? Would you be a buyer at these prices, or you look for?
I think that decline was justified. That gross margin number kind of freaks me out. Like that's a pretty big deal. And I mean, if you go back and look like quarter to quarter for pretty much those 5 years, like it's
it's just a constant decline.
It's really rough. Like not just gross margin, it's like everything's down like that. I think right at like 160. Let's just say it's 160. I don't know what's trading at right now, but at 160, I feel like you're in no man's land with IBM.
Yeah.
I think you're more bearish than I am, but I think at 160, I mean, I'd be interested in buying it under 150 maybe.
Yeah.
For like a starter position, I guess, and then selling, higher than 160. So.
Yeah, I mean,
it's kind of, I think you're like right in the middle. It's
right.
It's a rough space.
And honestly, I think I agree with you. I think I probably was more bearish coming in, but after this quarter, I think there's room that they have a window now that if they can actually hit it, which I think there's a story where you can see them actually hitting their targets, and if they can pull that off, I think they have a decent chance for share appreciation. Not a great deal, but at 160, I think it's a reasonable risk. And like what you said, I mean, if it was below that, I think it would become more attractive.
I think Ginny she turns 60 pretty soon, right?
Yeah.
Are you expecting her to kind of be forced out? That's kind of IBM's.
Yeah, I think they'd probably bring in someone right below her though, so I don't think the strategy would change that much. What would be really interesting to me is if they change the name, because this is not a mainframe company anymore, or at least they don't want to be perceived as a mainframe company.
I didn't think about that.
They should change it to Watson. I mean, if it was just Watson, I think that would have at least a cursory positive effect. I mean, it shouldn't, but I mean, you've seen this in the past from other companies change names, and they have a little more cachet in that. Now they're perceived as a growth company all of a sudden.
Share price wise, if she was forced out, would you expect movements in the share price?
It's just such a big company turnaround. I think it would probably boost up a little bit, but I don't think it would be sustainable, because I think it's just so difficult to turn a company like that around. I mean, they're trying to. They're making all these acquisitions, but man, it's just nothing sticking. It's so big, so bloated. There's so much going on behind the scenes that just isn't clean. I mean, you look at their accounting. They just need to clean up. I mean, compare IBM's accounting to Apple's accounting. I mean, it's night and day. A kindergartner could understand Apple. I don't think Carl Icahn. Well, I don't think I don't think the most sophisticated investor would be able to understand IBM's accounting statements and say, yes, that makes sense. Yes, that makes sense. I totally agree. I think that's a much more difficult task.
Yeah.
So this has been the Investing Podcast. Let us know what you think. We are now verified on YouTube, so subscribe, join the throng, and let us know what you think, and we'll be back here again. Thanks.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.